Hi everyone, welcome to chapter 14. We're talking about partnership businesses. So first, just a little bit of an introduction about partnerships, which I often abbreviate P-ships. So does everyone in the tax industry. Just to review the legal and tax sides that we discussed first in this class. So a partnership is formed legally if there's an intention of two or more people or entities, like other businesses, to share in profits and losses. They cannot just share in losses. They have to be sharing in profits and losses. A business doesn't exist for the sake of losses. The second option is they could form a legal partnership. An example of that is an LLP, which is paperwork that's filed with a state. These are specific state entities. The third option is a multi-member LLC, and this is probably the most common option these days because it gives everyone limited liability and it's a bit more effective to put it as simple as possible. So all of these legal entities, for taxes, they're called a flow-through entity, and they're all taxed as a partnership. That means that the business files Form 1065, usually pays no taxes. The concept is it pays no taxes. At the back of Form 1065, there's a Schedule K-1 for each partner, which splits out the business activity based on each partner's share of the business. Each partner then reports their K-1 on their tax returns. So one concept that we're going to talk about a lot is basis, the partner's basis in the business. And this is basically like saying the value of the investment, much like all of the asset sales and concepts that we've been learning the past month. So this is an example, very similar. Sale price minus adjusted basis equals gain or loss. That concept applies to the basis that a partner has in the partnership. So this is also called partnership investment, interest in a partnership, or the partnership percentage. All partner shares are based on a percentage. A partnership is formed when the partners contribute money, assets, property, or a promise to perform services. And so that's really common that partners will get together. Someone has the assets, someone has the money, and some people are going to do the work. And these days it's really common for them to form an LLC and then to be taxed as a partnership. Every partner must have an ownership percentage and the rules apply. So sometimes people will try and be like, I'm a partner, but I don't have I'm a 50% partner, but nothing affects me. You can't do that. You're taxed no matter what. Your basis is affected according to the rules, which are certainly similar based on the property rules we've been learning. A contribution, so this initial contribution when the business is formed, typically has no gain or loss, and instead, any gain or loss is deferred in that partner's basis. And this concept goes along with the property transactions we learned about. Now, this does create multiple bases for both the partnership and the partners, and this is not really a concept we touched on yet. So it's really specific to the partnership rules. A partnership interest is a capital asset. This is a little misleading unless they work in the business. When they work in the business, there's additional impacts from that, but essentially every partner's interest is a capital asset, even if they work in the business. So for a partnership business itself, they have an inside basis, which is the partner's share of basis of the assets in the partnership, and an outside basis, which is the basis in the partnership interest in the hands of the partner. So essentially what this means is when a partner contributes assets, the business can have a different basis than the partner who contributed the assets, because we're going to defer gain or loss. And so that's going to be reflected in the partner's basis. And so you end up with at least two different types of basis. I started my public accounting tax career in partnerships, and I experienced all the basis. These are typically very complex spreadsheets, and it can be really overwhelming if you don't have a background in this. We're not even going to get into all of these other scenarios that can happen, but you'll understand the concepts. So each partner reports income lost from the partnership. They cannot assign taxability. They can't say, oh, I'm a 50% partner, but I'm not going to pay tax on the share because I didn't take any money. Doesn't work that way. Small businesses should avoid forming a partnership unless they're prepared and with activity to justify the additional, resources that they need to really handle the partnership properly, right? You're taking a whole class to learn this. And many people try to do this stuff themselves. Partnership contributions. So when a partner contributes property, assets, their depreciation and their holding period carries over to the partnership business, which means the partner business just picks up where they left off on depreciation. The partner stops and the business picks up where they left off. The partner has no gain or loss, just like when we had like-kind exchanges. And instead, we're going to defer the gain or loss into their basis. We defer a gain. If you think about it, we defer a gain by decreasing basis, and that will make the gain bigger later on, and the opposite for a loss. Basis of contributed assets in the partnership is the fair market value. So the partnership is going to get a basis of the fair market value, but their assets are going to continue depreciating according to the partner's basis. So there's a lot to keep track of. So first, our basis calculation, just a generalization here. Cash that's contributed increases the basis. Basis in assets, increase basis. The partner's adjusted basis carries over, but the business gets the fair market value, and that increases the partner's basis. Depreciation and holding period from the partner carries over, and there's a tax basis balance sheet because even the business has two different bases. Now, of course, this does not include ordinary income assets, inventory, and accounts receivable. They're always treated as ordinary income property. With liabilities, the partner who gives up a liability, if a partner, say, gives up a liability, they contribute a building to the partnership and it has a mortgage on it and the partnership takes on the mortgage, the partner is treated as having got cash for that. If the partnership assumes a liability for a partner, the partner got cash. That cash, what they receive, decreases that partner's basis, and then the liability by the business side is going to allocate it to all of the partners based on the partnership interest increasing their basis. So this gets much easier in examples. Don't try to do the problems from memory. Look at the outlines in the book, look at your cheat sheet, and take these notes, and that's the way to do it. Definitely don't try to go from memory. At first, it'll be pretty frustrating. So these examples are really helpful. Bart and Allen formed an LLC to build personal residences. Each is a 50% partner, sharing income and loss items. Bart contributes to the following assets to the partnership. Bart contributes the following assets to the partnership. Undeveloped land, his basis is this column, fair market value is this column. His land, $55,000 basis, $100,000 fair market value. Equipment, $35,000 basis, $50,000 fair market value. So the total fair market value is $150,000. His basis in those assets is $90,000. Alan, the other partner, contributes cash of $90,000. That's his basis. Fair market value is obviously the same. Office equipment of $30,000. Fair market value is $40,000. A truck with his basis of $5,000. Fair market value of $20,000. So his total assets are $150,000, same fair market value as the other partner, which is normally what you would expect, right? Because why else would people agree if it wasn't fair? But their bases are different. So let's look at Bart's basis. His outside basis is $90,000. That's the basis to him as the partner, whereas the inside basis is $150,000. And his percentage is 50%. Alan's basis outside is $120,000. Inside is $150,000, of course. Same percentage. So you see how that works. Now we said that the partnership has a different basis. So our tax basis balance sheet, here we can see what this would look like. So you can see the problem data still provided up here. You can see our equipment here on the business's balance sheet. Although the business itself is using the fair market value to calculate the basis for the partners and take that basis, then they have a tax basis balance sheet, which is based on their depreciation numbers, which carry over from the partners. So you see the equipment at 35 right here, the office equipment at 30 right here, and the truck at 5,000 right here, undeveloped land 55. So you see how this works, and that totals, remember, total assets equals owner's equity plus liabilities. In this case, we have no liabilities, but the owner's equity, look at how that works out, right? Because we used their tax, these are the tax basis side for the balance sheet. Okay, so another example. Jose contributed a piece of equipment to JWS Partnership on March 1st, 2017. The cost of the equipment was $20,000, and year 2017 was the third year of depreciation under 7 years makers. The depreciation for equipment for 2017 would be calculated as follows. So this was Jose's depreciation expense in the first year on his Schedule C, right? Self-employed business. Then he's got 2016, the biggest year. And then for 2017, because he transferred it on March 1st, he only gets January, February, 2 months. So he takes his regular percentage from the table based on this information, based on the third year for 7-year makers property, that he grabs his percentage times the basis times the amount of time. Then on the other side, we have the partnership taking it over here. You can see that taking on the 10 months that are left in the year, and everything else just stays the same. Jose gets 2 months on his Schedule C, part of his self-employed business, and then the partnership deducts the other 10 months. You'll see how this flows through from on the Form 1065, on the Schedule K-1s, and then they enter them on their personal return. Another example. We'll continue this example here. So 14-5, Jose contributed a truck to the partnership that he had used personally for 4 years. The truck cost $28,000 and has a fair market value of merely $8,300. So this property did not appreciate. So what is the basis to the partnership, and what type of depreciation would apply. So we always take the fair market value, right, to the partnership, the 8,300, and we would look up the depreciation rules and see where the truck was, 5-year maker property, just like we learned before. Okay, example 14-7. Russell, Kevin, and David form a partnership. Russell and Kevin are wealthy investors. David is an expert construction contractor. Russell contributes a 20-acre parcel of land, and Kevin contributes cash. David agrees to perform all of the work to develop the land into a high-end subdivision. Now, you can see Russell's land, basis 200,000, fair market value 300, he's getting 30%. Kevin's cash, 300,000, obviously it's worth the same, he's getting 30%. Now, David's services, what do we do here? So, what is David's basis? It can't be 0 because he has 40%. We have to allocate those services value based on the fair market value of the business. So because the fair market value is 600,000, he gets 40% of that. Russell will get 30% of 600,000, Kevin will get 30%, and David will get 240,000. So there we'll talk more about how this all comes together. So David is taxed on this share, and it becomes part of his basis because he's taxed on it. And it gets more complicated. Try to keep it simple. The text does keep it pretty simple. So, yeah. Partners versus employees. So when a business hires workers, if they're hired as an employee, they must be paid as an employee. If they're not an employee, then they get a 1099. That does not apply to partners who work in the business. They're never paid as employees, and instead it's all affected in this unique way specifically for partnerships. It affects their basis instead, but the net effects end up being fairly neutral, and they do pay self-employment taxes on their income. Now, guaranteed payments are basically when there is a salary or an amount that's guaranteed for that person to get. So, like in our last example, that if he was actually paid that amount in cash, then that would have been a guaranteed payment because it was set, and fair market value of services is included in income. Guaranteed payments cannot be based on the revenue of the business. That's really the big qualifier. They have to be determined in advance, set payment, and not based on the sales of the business, because that's essentially getting a percentage of sales, which is just getting your partnership interest. Not that it's, sometimes people get really caught up in wanting it to qualify that way. There isn't a huge difference. If they're working in the business, they're working in the business. They're going to pay self-employment taxes either way, which are really your Medicare and your payroll taxes, which an employee pays as well, Medicare and Social Security. Okay, so basis of a partnership interest. This is the proper language, proper 3 steps. Basis is first increased and decreased by all adjustments except for losses. The adjustment, what this adjustment comes out to, is reduced by money distributed, including liabilities assumed on partner's behalf, which is considered cash received by the partner. And then the adjustment is reduced by the basis of any property distributed to the partner. I've said that a few times. Liabilities are treated as cash received by the partner. The partner's basis in a partnership can never go below zero. And if it does, the amount is taxed and then it increases the basis. So this is a summary of what to do with each item. This is a good thing to look at, to put on your cheat sheet and to use when you are taking notes. Notice if you got something inherited or received by a gift, then the beginning partnership basis, much like if you get an asset as a gift, is the fair market value at the date of death of the descendant, and then a gift basis is typically the donor's basis plus any gift tax that that donor paid if it had appreciated in value. Here's another example. Angie contributes an office building to a newly formed partnership for a 25% interest. The building has a $300,000 fair market value. So here's Angie. She gets her 25% interest. They're all 25%. It's not labeled. The building has a $300,000 fair market value, 160 basis, and is subject to a $100,000 mortgage. So the partnership assumes the mortgage. What does that mean? Angie got $100,000 in cash. Each of the three partners contribute $200,000 in cash. Calculate the basis of each of the partners. So based on that information, we're calculating each of their basis, like as if they're starting out, right? So each of them donate cash. Angie donates her building. So is she going to use the fair market value or her basis for her basis in the partnership? She contributes the property. Her basis is what her basis was in the property when she contributed it, $160,000. Just like that's the basis rule for like-kind exchange, right? Before we account for boot involved. So then, because she let go of a $100,000 loan, she's treated as having got cash, and that decreases her basis. So we're subtracting $100,000 from her $160,000 adjusted basis of the property. That becomes her basis in the partnership when she contributes that building. Now we're going to allocate that liability in the partnership that the partnership has taken on to each of the partners. And so they each get allocated according to their 25% partnership interest that they each have. They each get $25,000 of that liability, and it increases their basis. So the three partners become $225, Angie becomes $85. Now 14-9, what if Angie's basis in the building was only $45,000? Then we have the same calculation, right? But we start with 45 instead of 160. This number is arbitrary. It's just based on her investment, right? So we start with 45, we add 25, and just to point something out, why would they still be willing to let her put that in? Well, the fair market value is $300,000, and she had a liability of $100,000. So her putting in that building of $200,000 was completely as fair as each of the other three partners giving $200,000 from the business's perspective, just to make that clear, regardless of what her investment or what she owed on it is. So $45,000, starting with this new basis, we add the 25, we subtract the 100, and we are negative $30,000. Remember, we can't go below zero, so that means we have a $30,000 gain, tax on the return, capital gain, and our basis is zero. I'm sorry, the basis becomes $30,000 because they're paying taxes on the $30,000. Okay, so now we're going to talk about the form a bit. Form 1065 starts with page 1, Ordinary income reports income expenses. Page 2 and 3 are pretty much informational. They're Schedule B. Page 4 is Schedule K, which are called separately stated items that flow through on the Schedule K ones to the partners. Page 5, Schedule L, M-1, and M-2 are reconciliation with the balance sheet, not required for smaller businesses. So this is page 1. You can see at the top is the traditional informational questions. Then we have gross receipts, all sales income, just like on Schedule C. Then we have deductions, salary and wages, guaranteed payments, and that brings us to this ordinary business income total. And then we have tax and payments. And so this confuses a lot of people, and they say, do I have to pay taxes? No, these are just for specific situations. Often if a business has been a different type of business and then becomes a 1065, or for specific situations that are far less common that we won't cover, then they sign, paid preparer signs. So now we'll take a closer look here. So here's the income section. Just like other business returns, we have cost of goods sold, gross profit, ordinary income, special section for farm income, or if assets were sold by the business, and any other unrelated business income. And so then we have our deductions. So these are the categories, much like Schedule C. They're very specific, but all of your business deductions essentially fit in here. Salaries and wages, guaranteed payments to partners, which we mentioned, we'll talk about more, repairs and maintenance, bad debts, rent, taxes and license, interest, depreciation, depletion, retirement plans, employee benefit programs, other deductions. And so if nowhere else, everything goes there. Expenses minus income, ordinary business income or loss. Already explained that section, the taxes that apply to specific situations. So ordinary business income begins the allocation and is allocated to the partners. Guaranteed payments do reduce ordinary income. You saw them listed under the expense, but they're also treated as income to the partner who received the payments. So it's not called salary, but it's a situation like salary. The guaranteed payments cannot be based on the amount of income in the business, because that's essentially what a partnership interest is. Payments to partners are treated the same, essentially, regardless of if it qualifies as guaranteed payments or not. I mean, there are some differences, but the ultimate effects are not really different. So this is page 4, and this page has some various reported items. You can see all of these look familiar. Self-employment income. This is the ordinary business income loss from page 1 that's reported right here in line 1. Then we have net rental real estate income, other gross rental income, expenses from other rental activities, guaranteed payments, interest income, dividends, royalties, net short-term capital gain, net long-term capital gain, collectibles capital gain. Remember, they have the special 28% rate, unrecaptured section 1250 gain, net section, all of our different ways, basically, that income and activities can be treated, and also depreciation and specific deductions like charitable deductions. You can see down here, investment income, investment expenses, non-deductible expenses such as 50% of meals and entertainment. And so all of the information on that Schedule K transfers to here. Part 3, partners' share of current year income, deductions, credits, and other items. And these are the items that are then reported on the owner's return. The information over here is primarily informational, but you can see beginning percentages of ownership and ending. You can also get a little capital account assessment, but you have to know if it's tax basis or what basis it is. So often I find businesses that don't even have a clue. They haven't been tracking those multiple bases. It can be really hard to figure out what's going on. The business information whose form this K1 is attached to or part of is in the top, and the partner's information is below. So separately stated items are allocated based on that percentage. Schedule K times the partner's percentage equals the amount of each item in part 3 of that Schedule K1. And that is why this is called a flow-through entity. That's how it occurs. Separately stated items, here's a list. I basically just read through these. And the reason they're separately stated is because the partner is going to report all of this income. So a lot of times partnership investors will form partnership pyramids. That's what I started doing taxes on. So they'll get all sorts of K1s and they'll net together their activity. So something like charitable deductions, a business might think it's going to deduct, but really it's just an itemized deduction on the personal level. And if the person, say, doesn't itemize, they don't get the deduction. So all workers, all partners working in a partnership are subject to self-employment taxes if they worked for the income they received. And that's a recap of the self-employment taxes. So example, Knox is a partner in Knox, Smith & Wood partnership. He owned 33.3% from January 1, 2017 to March 31, 2017. When he bought Smith's interest for 33.3%. He owned 66.6% for the rest of the year. The partnership had 76 of ordinary income and 8,000 of long-term capital gain. So barring any special allocations in the partnership agreement, Knox's share of income is, we take that ordinary income, that line 1, on Schedule K, $76,000, and we've got to calculate what he owned for the first half of the year at his partnership interest rate and what he owned for the second half of the year at his partnership interest rate. So for the first 3 months at 33.3%, he gets $6,333. For the last 9 months, he's going to get $38,000. Now we're going to add those together to get a total. Then we've got to do the same thing to the capital gain, and so we end up with $4,667. A partner, Allison, has a basis of $5,000 in a partnership at the beginning of the year. She gets a cash distribution, so she takes cash from the business. And her distributive share of income is $2,500, and she receives land distribution with a basis of $4,000. So we start with 5, that's beginning basis. Share of income increases basis, $2,500. She got a distribution, so that decreases basis, and she got a land distribution, which decreases basis. To know about tax, we basically have to know if she worked in the business. And that's not what we're looking at in that one. 14-14 is a great example because we're going to look at a Schedule K1 and we're going to pull the numbers from this Part 3. Now, keep in mind, they've already taken the 40%. These are already at 40%. The total of all of the Schedule K1's information in Part 3 adds up to the amount on Schedule K. So, if Wu's partnership basis at the beginning of 2017 was $22,000, calculate his basis at the end. So we start with his beginning basis. We add the ordinary income from box 1. We add the dividends from down here. Keep in mind this is ordinary dividends, qualified dividends. Just like on the individual return, ordinary dividends are reported here. If they're qualified, they're also reported in the qualified box. It doesn't mean that you add them together. It just means, okay, all of these ordinary dividends are qualified. We add the short-term capital gain from here. We're going to add the long-term capital gain from here. We're going to add our net Section 1231 gain and then subtract our other income loss items here on line 11. $2,600. How do I know that was charitable contributions? You got to look at page 2 of Schedule K1, A. Whatever the code is right here, there is a key basically where you look, line 11, code A, okay, that's 2600. And same for all of these lines. There's a spot to put a code and a spot to put an amount. And you look in the instructions to see what the code stands for. Now we're going to add in our section 179 expense, and that comes to 71,595. Now, what would liabilities do to his basis? They would increase his basis. This is another example you can look at, and then that's what we covered in the prior example. 14-5 is also one you can refer to. What would cash distributions do to his basis? They would decrease his basis, and you can look at that example. So now we're going to talk about some other distributions. Money and marketable securities, stocks, bonds, they decrease basis. We've covered that, but never below zero, but down to zero. Beyond that, it must be taxed, and then it increases basis because you paid tax on it. Now, that's just the basic concept. We have a few other situations we need to cover. A pre-contribution gain happens when a partner contributes property that is increased in value, which means they have a deferred gain, and they contribute that asset to the partnership. But within 7-year period, so 7 years or less, the partnership decides to distribute the property back to the partner. And essentially they're doing that to try and avoid the gain. And so what happens is the gain is recognized by the partner, and the same thing happens, that partner who contributed that asset happens even if the partnership distributes it to a different partner. That original partner recognizes the deferred gain. Because remember, no gain or loss is recognized when the partner contributes that property to the business. I know we already covered it, but we just learned it, so I'm reiterating that. And instead it's deferred. And so what they're saying is, if you try to give that back or give it to someone else within the 7-year period, because, typically the nature of business is much bigger, longer thinking than that, then we're going to say you're just trying to avoid capital gain tax. Property distributed from the business to the partner. So just like when the partner contributes property to the partnership, the partner steps into the partnership's basis. The holding period and depreciation basis carries over. And of course, it reduces the partner's basis in the partnership, but never below zero. And unlike cash and marketable securities, it's not taxed if it decreases the partner's basis below zero. Instead, gain or loss is just deferred in the asset's basis. The partner's adjusted basis in the asset. Sale of a partnership interest. So this is very similar to sale of a capital asset because the partnership interest is treated as a capital asset, investment asset, right? Amount realized from the sale, what is everything they got as part of the sale price, subtract the partner's basis in the partnership, their adjusted basis at the time of the sale, and that's going to equal a gain or loss. And we're going to report it on Schedule D, just like with other assets. If there's ordinary income assets involved in the interest, then they have to be reported as ordinary income assets. Remember, that's account receivable and inventory. They're taxed at ordinary income rates. Now, lastly, the book has like one small paragraph about the qualified business income deduction, also called QBI. This is the big Trump tax cut deduction. It's from Section 199A. It is a deduction based on income, which is not like any other expense deduction that we have in taxes. So you get 20% of income, qualified business income, as a deduction. It's flow through businesses. So it has to be business income, but this deduction is not a business deduction. It's on the personal form 1040. So it was a little weird that they mentioned it here. There's many limitations and rules. They didn't go into it. I'm not going to go into it in this video, but I will have a separate video about QBI. Okay, that is all.